This is Business Weekend.
Hi and welcome to Business Weekend. It's great to have your company. I'm Edward Boyd. Coming up, has our economy become fatter, slower and lazier? We catch up with the keynote speaker from the Jobs and Skills Summit, the Grattan Institute's Danielle Wood.
Productivity growth over the past decade has been significantly lower than we've seen at any time over the past 60 years.
We also sit down with Wisetech Global Chief Executive Richard White to get his views on Australia's tight employment market and figure out how he can be on a hiring spree when tech companies are under so much pressure. The profit reporting season concluded this week. Our business reporter Ingrid Willinge will wrap up all the big results, and I catch up with Woodside Energy Chief Executive Meg O'Neill.
We think gas is part of the solution. Gas is going to be an important commodity for decades to come.
Plus, British Trade Secretary Anne-Marie Trevelyan explains why Britain is well ahead of Australia in the race to attract skilled migrants. She speaks to the Australian's business editor-at-large, Tikki Fullerton.
We are keen and welcoming to those who bring specific skills to help us, because the most important thing is to help our economy to grow.
The Jobs and Skills Summit was held at Parliament House in Canberra this week, attracting more than 140 representatives from business, unions, industry and government. To address skills shortages, the Albanese government will lift Australia's permanent migration cap from 160,000 up to 195,000 each year. It will also fund an additional 180,000 places at TAFE and is aiming to have legislation ready by the end of this year to improve our enterprise bargaining system. Here's a few highlights from business and industry leaders at the summit.
Well, I think that, number one, I think this government's going to do a great job. I think that there's great opportunities for Australia to, industries that are going to be onshored again after being offshored to China. I think a lot of companies are going to, with all these supply chain bottlenecks due to COVID or due to the Ukraine war, there's going to be a lot of companies and industries come back to Australia, and I think that we should encourage that.
Look, I think it's been really pleasing, and it's been building on these relationships that have been started to be worked on over the last couple of months, and we're certainly looking at opportunities of consensus here and opportunities of taking things forward. I think what's been really fantastic is an acknowledgement that small businesses play a really important role in the economy, and it's important to acknowledge all the difficulties that they face to help them continue to build the economy through great employment, great innovation and keeping connected with their community. It's just so important.
I think it's just common sense. We actually need more skilled labour here, but we've got to work incredibly hard on getting our own homegrown skilled labour. We have to look for our children, our less, if you like, fortunate population. We've got to look hard at our vulnerable populations.
There is a large shortfall in long-distance heavy drivers particularly. We're heading into peak, we've had COVID. Our drivers are being recruited to go back into the mines. The Ukraine crisis has added that challenge, and it's only going to grow. But I'm really hopeful that conferences like today, organised by Jim Chalmers, is a really positive step forward for long-term planning for what we need for our country. But I personally would like us to change how we measure unemployment. Unemployment today includes part-time workers. There are 13 million women that live in this country, and only 3 million women work full-time. We complain about we don't have enough super. We won't have enough super for your generation if our generation don't ensure we start addressing the underemployment crisis of women.
So what we want to see is those businesses right across the country, small businesses, farming businesses, getting skills from both on-the-job training and from increased migration. We need skills in this country from the very basic right through to the most advanced. Australia's banks need those advanced skills, but the customers that those banks bank, small businesses, big enterprises, they're desperate for labour and they're being held back because they cannot fill jobs.
This discussion is heading in the right direction. We need labour. It's the number one issue for business at the moment. the quickest short-term fix is by lifting skilled migration. Then we also have to deal with our own skills crisis.
The boot test is going to be re-looked at, which we applaud. We need more flexibility in the workforce and greater productivity so that we can share those benefits with the team.
The devil's in the detail. There's some detail we need to see out of this to see how it works and make sure there's not unintended consequences, and that's what we're all waiting for.
Grattan Institute Chief Executive Danielle Wood delivered the keynote address to the summit on Thursday, where she described Australia's economy as fat and lazy. I sat down with her on the sidelines of the summit to understand how we can boost productivity and get our economy firing on all cylinders.
So what I was really focused on is, first of all, talking about how the Australian economy is evolving. So the move to the services sector, the rise of digital and the potential that brings, as well as the shift to green jobs as we increasingly decarbonise the economy. But the key messages were really to get ready for those shifts. We need to invest in educating and training our people, and in many ways we're failing to do that at the moment. We need to tap into our talent pools, so things like building women's workforce participation is a really important part of the story. And we need our economy to be a bit more dynamic, and business has been a little bit sleepy in the past decade, and we need to wake that up to tap into this future potential.
Is it fair to say productivity growth is plateauing at the moment in Australia?
Yeah, so productivity growth over the past decade has been significantly lower than we've seen at any time over the past 60 years. So that is a massive problem. We know that productivity growth is what we need in order to see incomes and wages growing again. So that is why, I was really pleased to have that as one of the big themes for the opening session.
How do policymakers improve female workforce participation?
So we know that the number one barrier is for women with children getting back into the workforce, the high cost of childcare. We have some of the highest out-of-pocket costs for early learning and care of anywhere in the OECD. Government and federal government and state governments are taking steps to improve that. This morning I talked about paid parental leave as another piece of that puzzle. Because women are taking on such a high share of unpaid care, that means that constrains them from participating more in the paid workforce. And we know when dads and partners are more involved in taking leave, particularly in the first year of a child's life, that pattern continues and therefore women participate more. So I think that's another area where Australia can really push forward.
Another thing you talked about was investing in human capital. Who's got to take the lead on that? Is it federal government? Is it state government?
Ultimately, I think it's a mix of both. So our school education system is actually not performing particularly well at the moment, and one of the statistics is we are going backwards. So that does require, it's not simply money though, it's actually changing the way we deliver education services to make sure we're actually improving our children's learning. Vocational education and training is another really important theme of this summit. That system has withered on the vine. That's going to require money from Commonwealth and state governments, and actually we've had an announcement coming out of the National Cabinet that there is a bigger commitment to now invest in that training system, which is absolutely crucial.
And Australia's corporate environment, is there enough corporate competition in Australia with some of these really bbig companies that were there today?
Yeah, so certainly I think it is a concern, and there's evidence that it's less turnover at the big end of markets now than there once was. So we did some work that showed that about a third of the most profitable companies were in that same group a decade ago. So we're not really seeing these kind of new innovative competitors coming in and upseating the incumbent firms. So that suggests to me that there is a competition problem. One of the things we should look at is competition laws and policies to see if they're working, as well as doing other things to encourage businesses to be more dynamic.
What's the reaction been already to some of the people in the room there, some of the biggest business leaders in Australia? Have you had any thoughts from them yet?
Look, I mean, they were actually largely positive and responsive, even though, I was saying that the business sector had become a little bit fatter, slower and lazier in the recent decade. But look, I think the people in the room are thinking about these issues. A lot of them are grappling with, how do we bring in digital economy, things like AI into our business models. So they are thinking about this right now, and really hopefully that they come out with an appetite to sort of push the envelope on this stuff. And how close is our economy to that level of full employment? Look, I think certainly we are, you'd have to think we're pretty close. I mean, the ultimate definition is when we see wages start to pick up. I think there are some early signs that is happening. It takes a little while, but, I think that's probably the direction that we're going. And with that, we've just seen 100,000 people that weren't in the labour force before COVID that now have a job. And, that's a really positive thing. Yeah, you mentioned wages. What's the best way at the moment for people to get a pay rise? Is it by changing jobs? Yeah, so we know that when people switch jobs, on average they get about an 8% pay rise. And so this kind of low rate of job switching that we've seen, and it has been falling really for a decade. We haven't seen this great resignation that we've been hearing about overseas here. That has slowed overall wages growth across the economy because people aren't moving around. So I'm certainly not going to give anyone individual advice about leaving their current employer, but as an economy, if we had more job switching, we would expect to see overall wages growth being higher. What about skill shortages? There are a lot of people in the room talking about that today. There's probably two ways at which that's coming in to the conference. So the first is this discussion of training, and particularly things like vocational education and training, making we're training up Australians to fill these roles that we need. The second way that it will come in is really the migration system. And it's not just about actually the number of migrants, it's the composition that we're bringing in as well. So we've certainly argued that this reliance on these kind of skills shortages list to decide exactly which professions come in don't make a lot of sense. They're particularly bad for sectors like tech, where they're creating new types of jobs all the time. The lists just don't work. So having something like a wage threshold instead, if you're going to be paid more than that wage threshold, you can come in, you get rid of all that bureaucracy, and you really target our migration system to bringing in the highly skilled workers that we need. We've also got high inflation in our economy, rising interest rates. The Reserve Bank meets next week. What's your sense at the moment of the strength of Australia's economy? So we still have quite strong demand. I mean, it's pretty extraordinary really to think that we came out of the COVID recession with higher spending in almost every segment of the economy than what we went in with. That is, when coupled with what we know is some pretty significant supply disruptions, is causing higher price rises than the RBA is comfortable with. So I think, we probably have a little way to go on the tightening cycle. The RBA is worried about expectations shifting, and they want to bring down price levels as quickly as they can. Danielle Wood, Chief Executive of the Grattan Institute. Thanks for your time today. Thank you for having me. Migration, skills shortages and wages growth. These are some of the big issues Australian employers and unions flagged at the Job Summit this week. I sat down with Richard White, the head of supply chain software company Wisetech Global, to get his perspective on the challenges facing the technology sector and the ways our employment system can be improved.
We need an increasing number of highly skilled technology workers. And Australia currently doesn't produce enough to satisfy the growth in the technology sector in Australia. Technology in Australia is batting way above the average of the world. We are doing much better than people imagine. Now, the problem is if you can't hire people in Australia as Australians, you have to either import them or you have to push those jobs overseas. So the visa processing system is very backlogged, and I appreciate there's good reasons for that. But it's a considerable constraint, and it's causing us to lose very high-value candidates that we need to bring into the country. Equally, the education system needs to be able to produce more so we don't have to bring people in. We can hire here.
So is education really the big solution here?
It has to be the long-term solution. You can't just keep importing the solution. You have to build it locally. I mean, Wisetech has built its business really fundamentally in Sydney, Australia, from skills here. And now we're very global. We have a lot of staff overseas, but Sydney is still our biggest employer anywhere in the world. And we need to, and many other technology companies need to employ high quality people in the local marketplace. If we can't do that, we've either got to import them or we've got to put those jobs overseas.
On Friday at the summit, the government announced it was going to lift the migration cap to 195,000 per year. What impact's that going to have on the employment sector?
Well, in the short term, it probably won't have a substantial impact because the visa processing queues are the current constraint. It's a good thing to do. Don't get me wrong, that's the right thing to do. But in the short term, it's the visa processing queues that have to change. In the medium term, the cap is important, but in the long term, it's education. At K through 12, getting people into STEM, getting people to understand technology is a valuable career, and then getting universities to adapt and deliver high-quality jobs from their courseware.
How many potential employee candidates do you think you've lost due to that backlog in the visa processing system?
Look, I think probably 2 in every 3 don't turn up in the end because they can't wait 4 months to know that they've got a job. So they'll get another offer from somebody else in another country and they'll go somewhere else. Now it means that we have to scale much more widely and do a lot more offers, and we're just losing opportunity. But I would say 2 in 3 are not willing to wait 4 to 6 months to come to Australia.
The tech sector has been under a lot of pressure over the last 12 months. Many companies are slimming down and getting smaller. But Wisetech's hiring. What's the big difference with you guys?
Okay, so if you look at the tech sector, it's made up of a lot of different types of companies. There's startups. They haven't necessarily got a product. They don't necessarily have customers. They don't necessarily have revenue. Or they're very nascent. And they burn a lot of cash. And a lot of those ideas may never become commercial. Those companies were going to have difficulty raising money and difficulty holding on to employees for that reason. And they may be letting people go, trimming their workforce. In the companies that are high-growth companies, there's sort of 2 models. There's these cash burn companies that have great growth, but they're burning huge amounts of cash. I heard one company the other day, I won't name the particular company, but they've added $1 million in revenue, but it cost them $11 million in losses to make that $1 million of revenue. That's an unsustainable ratio. So those companies are losing funding and employees are leaving those companies. Wisetech is very high growth and it's very profitable. And because of that, we're very attractive now to people that would think, oh, cool to go and work for a startup or cool to work for those other companies. Now Wisetech has become like the new black. It's kind of cool because we're very profitable, we've got a great strong balance sheet with a lot of cash on it. We're growing very quickly, we've got a great reputation, a great client base. People want to work for a stable, long-term employer.
How many people have you roughly hired in the last 12 months?
A few hundred, but that's because of the constraints that were present. So we've also moved a lot of people from our non-core businesses into our core business. About more than 300 people have moved into the core business. So probably net about 500 people have been added to the company.
You reported your results last week, revenue, dividend and profit all increasing. Just talk about the strong year that you had at Wisetech.
I tend to look at this from what we call the 3 Ps: product, penetration and profitability. So in product, we did 1,199 enhancements to our core platform, which is quite a big platform. It covers much of the logistics space in international. And we've done some amazing things about increasing productivity, increasing capability, and doing new things that have added to our ability to grow the company. So that's the product piece. In penetration, we signed 5 new customers this year that are major global freight forwarders, including UPS and FedEx. Now, we've got some fantastic, very large customers, but if you think about DHL, where we signed in 2016, UPS we signed this year, and FedEx, they're the 3 most known brands in the world, and they're now all major global customers of Wisetech. Another 3 of those were quite important large customers, and another 5 grew from our small customer base into what we call large globals, just organically because of the power of our platform. So that's the penetration piece. That's working really well. And then we've spent the last couple of years, during COVID and post-COVID, making the company hyper efficient, looking at how we can produce more software more efficiently, looking at how we can integrate the businesses that we acquired, looking at how we can build a really profitable business from the capabilities that we had by moving things around, by adjusting, by really thinking about how to engineer a business to be hyper automated.
You've got a very global, overarching view on how supply chains are tracking. What's your reading into them at the moment?
Well, I do, and I will caveat this by saying that it's our view, because CargoWise is a very high growth company, and so some of the growth I see is our growth, not the world's growth. But we do have very solid information, and some of this is from journals and publications, and some of it's from our customers, and some of it's from our own statistics. I'll start by prefacing this and say that in February 19, 2020, we had the invidious, terrible task of going to the market on our half-year earnings and telling the market that COVID was a very serious thing and it was going to hurt us all. And of course, we were punished for being the messenger. We did very quickly recover from that, because it turns out that the goods systems grew very rapidly because people were locked down at home and are buying art supplies and exercise equipment and home handyman stuff, and so our business actually boomed. But we had to honestly tell people that we saw this huge thing coming called COVID, which most people thought was sort of imaginary when we said it. Anyway, we've done very well through that, but what I can tell you right now is that there's a lot of facts that point to the international supply chain still being very full and actually very backlogged and still quite choked. You think about the Port of Long Beach and what's called LALB, just reported their biggest ever volume in June, and July was pretty similar. So that's one indicator of very strong movement through supply chain. There used to be about 80 vessels sitting behind Long Beach waiting to get unloaded. That's dropped to about 20. So that's a sign that some things have started to improve. Last year, the global container fleet of marine containers grew by about 14%. That's helped a bit. This year it's predicted to increase by about 10%. And we can see now that the empty containers available in the US market, which is the biggest market by far, have started to become much more available. So I can see the green shoots of these supply chain restrictions and problems starting to abate. We've also seen spot rates start to match the long-term contract rates. And that's an indication that the supply chain is becoming more balanced. But it's still way above 2019 price levels, so it's still got some way to move. And then I can tell you from our own data that even though the COVID zero policy is still active in China, China is pumping out goods at a faster rate than they've ever done before. And in fact, we can see that there is no abatement of export containers, no abatement of bookings. Those bookings are probably 2 weeks before the container moves, and the container is probably 6 weeks before it arrives in Long Beach. So there's still lots and lots of volume. And if you know about the chip shortages, and there's difficult getting timber and getting steel as well, there's lots and lots of back orders that are 6 or 9 months old that people are not getting supply. So there's still a lot of buffer behind that. So from the short to medium term, in the next 6 to 12 months, I think we're in pretty good shape. And certainly Wisetech and its customers are in pretty good shape.
Richard White, Chief Executive at Wisetech Global, thanks for your time today.
Thank you.
Coming up after the break, we recap the highs and lows of the company reporting season and speak to the head of one of the world's largest oil and gas producers, Woodside Energy. Welcome back. This week, the profit reporting season finished up, and as usual, the outlook statements from our top ASX-listed companies have been closely watched by the market. Inflation, labour shortages, rising power prices, supply chain constraints, these are just some of the economic challenges that have featured prominently over the past few weeks. Business reporter Ingrid Willinge recaps the highs and lows of the company reporting season.
A reporting season like no other. Boards facing a culmination of headwinds that they may never have before. Post-pandemic inflation, labour shortages, higher interest rates and global unrest, just to name a few. This is what corporate Australia is grappling with. But business remained quite resilient, with around 90% of companies issuing full-year results delivering a statutory profit, and revenues mostly outpacing expenses.
It showed sort of an environment that it was tumultuous, but certainly businesses have done well, and I think there's going to be right to be caution about the future. But yeah, resilient I think is a good way to describe corporate Australia. They've gone through this situation so quite well.
From a sector perspective, results varied. Non-financial industrials saw a big upgrade, reflecting strength.
On the positive side, the revenue was holding up far better than feared, as well as the outlook for the revenue growth is actually very strong. We actually saw, taking out the financial companies, the non-financial industrials for ASX 200 has been upgraded by over 1.5%. Now, this is one of the biggest upgrades in the last 20 years. So, do focus on that, because that just means the consumer's holding okay, our corporates is holding okay, and offset some of those cost pressures.
Dividends have been plentiful, but balancing returning cash to shareholders with growth options, M&A and keeping a safety buffer is something that needs to be approached with delicate hands. Still, over 80% of companies chose to return that cash.
It's also another sign that the corporate Australia, the balance sheet is very strong, even though the debt cost has gone up. But most of them, some of them is pretty much debt-free. So in this sort of environment, we should expect to see more buyback, more dividend in the next 12 months. Aside from that, mergers, M&A is going to pick up as well. We actually saw a few bids throughout this reporting season, for particularly in the technology sector.
Mining companies were top of the list for dividends, shareholders rewarded thanks to soaring commodity prices.
We did have some tailwinds in terms of commodity pricing last year. However, we were able to fully capitalise or maximise the returns on those tailwinds through the strong underlying operational performance. Now, in looking forward, we do want to be growing value for all stakeholders, and that's going to require this balance of fresh investment versus unlocking maximum returns from the dollars already invested. What everyone can take confidence in or be confident about is that we will be operating this business for its maximum potential for the benefit of shareholders.
It was, though, a double-edged sword when it comes to energy prices. The Russia and Ukraine conflict left businesses grappling with higher input costs. But on the flip side, energy prices riding high.
Yeah, certainly it's been an extraordinary year in energy markets in Australia, but also globally. And if you look at Origin, we are a diversified and integrated energy company, and it does highlight that this year because we had a very strong result through APLNG and our integrated gas, but at the same time we had a lower result sitting in our energy markets business as we navigated some of the events domestically.
Travel stocks did particularly well also as Australians took advantage of borders opening and lockdowns lifting to catch up on much-needed miles.
The good thing for us, though, was not just brought back, it really came back a lot harder than we thought, but more importantly, we were able to turn that recovery into revenue and profits. And that's probably because we did three things right through the cycle. We're very high tech and innovating in tech to make it more productive for our staff. We carried a lot more staff, so we didn't have the same pressures as others to find staff, and we won a lot of business accordingly.
But Qantas suffered an almost $2 billion loss, only cushioning the blow with a thank you to investors, rewarding a $400 million buyback.
No other company in Australia, I think, was impacted more by COVID than Qantas. 25 billion lost revenue, 7 billion in profit loss. Those last 3 years of losses is more losses than the profits we made in the previous 5 years.
Retailers have been interesting. There's been a real tale of two halves. The first half messy with store closures and lockdowns. The second half more positive, consumers using that pent-up cash. Inflation and higher interest rates haven't had a big impact on consumers just yet, but it is front of mind for retail bosses.
Obviously, we worry. We're retailers. It's never good when household budgets come under pressure. I think one thing that we're really comfortable on is our market position. We're positioned really as a value-driven retailer that's very customer-centric, and that gives us great confidence going into what is this uncertain time.
And this uncertainty is a key focus for corporate Australia heading into the next financial year. A lot of companies refusing to give guidance at all, and those that did did so with a side of caution.
Treading carefully, I suppose, is the right way to describe how the Australian companies, they've gone through the last 12 months, and it's been a tumultuous last 12 months. And looking ahead to the future, the same challenges still apply. The job market is still tight. We still have the war in Ukraine. We still have the supply chain issues. We've still got inflation going up, and interest rates are likely to rise. In that sort of environment, it is hard for companies to give guidance. It's hard for companies to be able to define their strategy. But the success for companies going forward will be defined by how adept they are in dealing with the challenges.
Woodside Energy completed its merger with BHP Petroleum in June, making it one of the top 10 largest oil and gas companies in the world. I sat down with Chief Executive Meg O'Neill to understand the focus for the newly merged giant and get her views on the future of LNG gas.
So the prices obviously have been a supportive environment for us. Prices are significantly increased versus the previous period. But the other thing that's been really positive and impactful for our results is the merger with BHP's petroleum business, which was completed on the 1st of June. So we have 1 month of production from those assets, revenue from those assets, profit from those assets. And that's been a contributor to the wonderful results we've been able to report and the value we're able to return to shareholders through the dividend.
Those higher prices for commodities, obviously there's been a lot going on with the energy market this year. What's the outlook looking like for those prices going forward?
Look, every time you pull out the crystal ball, you know it's going to be wrong. One of the things that we think about when we make our investment decisions is long-term, how are things going to play out? But for shorter term, from a shorter-term perspective, you know, the oil market, there's a lot of questions. There's questions about supply coming back to market from places like Iran. There's questions about what demand is going to do if there are recessionary forces at work. LNG, which is 50% of our portfolio, actually has a lot of really positive tailwinds. So we're seeing Europe being pretty serious about moving away from Russian pipeline gas. They're backfilling that with LNG largely. So we think LNG is going to be pretty positive for the next couple of years because there's not new supply just waiting in the wings to come to the market. So, you know, that's a positive environment for Woodside to be in.
Well, now you've completed that merger with BHP, you are a much larger business. Has the management thinking strategy for the business changed at all now that you are so much bigger?
So the headline for the company is unchanged. Our desire and our goal is to thrive through the energy transition. We recognize that some of the short-term pressures that have caused energy demand and LNG demand in particular to grow, that's quite positive for the business, but we know that the trend to respond to climate change is one that we all need to respond to. We think gas is part of the solution. Gas is going to be an important commodity for decades to come. It's the lowest carbon intensity of the fossil fuels. It's a natural partner for renewables. It's safe, it's reliable, and countries like Australia offer the energy security that many of our customer nations like Japan and Korea want to see. So we think gas will be part of that energy transition. But for us, the strategic headline is unchanged, which is thriving through that transition.
So gas, big part of the strategic transition, but what within the Woodside portfolio might you actually consider now strategically looking at and saying we're not actually sure we need this anymore?
So we're going to take a look at the totality of the portfolio, but one of the things that's really positive when you look at both the heritage BHP business and our legacy Woodside business is that it was concentrated in a small number of really high quality assets. So we will be doing a portfolio review, but that's really going to focus on the growth opportunities and what's next in the hopper. We've got a number of different fields that have been discovered where we've got questions about, you know, well, what's the right order of trying to bring those forward. So really pleased with the portfolio we have. Again, big position in the U.S. Gulf of Mexico, big position in Australia, some other opportunities in places like Trinidad, Tobago, and Senegal. So very excited with where we are, actually.
How do you balance being a really big producer of fossil fuels and this shift to decarbonising the whole world? How do you sort of make sense of that?
I think the word that's important to focus on is transition. You know, we talk about an energy transition, and there are some who would simplistically say, you know, turn off the lights today and turn on the lights tomorrow, and it's a totally different source of energy. The world doesn't work that way. The size of the world's energy system is too vast. So for us, what's going to be important is being a responsible player as we go through that transition. We've got our own targets for reducing our own emissions towards our aspiration of net zero by 2050. We have a target of investing $5 billion between now and 2030 on new energy products and lower carbon services. So those are things that will help our customers decarbonize. So the key for us is making sure we're playing a responsible role in meeting the world's energy needs today, and also helping meet those energy needs of tomorrow that may be lower carbon products.
And as you work on these big projects, how difficult is it going to be to find employees to work on these sites?
So working at sites, we think we have a very attractive value proposition. And I was actually up at the Pluto Train 2 site last week for an official start of construction, and had a chance to chat with some of the folks working up there, and they said they were really attracted to working on this project because it's with a high-quality employer. So Bechtel, as our main contractor, has a great reputation in the industry. The project's going to take a number of years, so it offers certainty. So I feel really good about our ability to compete for talent. But it doesn't change the fact that nationwide, we just need more people than we have today currently in the workforce.
Yeah, those major projects, Pluto 2, Scarborough, Sangomar. Looking at the pipeline for those projects, you've got a big dividend payment in this half year. Can we expect shareholder returns to be lower as the CapEx just goes up for investment over the next few years?
So there are a few things that are important to us. First off is protecting our strong investment-grade credit rating. The second guardrail for us is ensuring that we're able to return value to shareholders over the cycle. We've reaffirmed our dividend policy is to pay out 50% of underlying net profit after tax, with a range of 50 to 80%. So every time we get to a dividend period, we look at a number of factors. We look at what's the price outlook for the future, what's our spend outlook, where does our balance sheet sit, and we make the decision at that point in time. For this particular half year, we're really thrilled to be able to provide that 80% net profit after tax payback to shareholders via the dividend.
You've also inherited the Trion oil discovery in the Gulf of Mexico. BHP were going to make an investment decision on that this year. What's the outlook for that project?
Yeah, so we've worked very closely with our joint venture partner Pemex, the national oil company in Mexico, to delay the timeline for that decision till 2023, partly because of the merger, and we needed to bring the two organizations together and make sure we were really understand the opportunity. But I think it's actually really positive when you look at what's happening in the market, some of the inflationary pressures. There's a lot of question marks about the supply chain and ability to deliver. So we've taken advantage of the opportunity to go back to the project. We'll be going through a retendering process to make sure we have absolute confidence in the costs to develop the assets. And we'll be looking to make a decision on that in 2023.
And then you got the project in East Timor. Can you just talk about the significance of that to Woodside and Australia, and what are some of the sovereign risk challenges of getting that across the line?
Yeah, so Sunrise is an asset that's been in our portfolio for a long time. It's an asset we would really love to see developed. When the maritime boundary dispute was settled in 2019, that triggered the next step in the process, which is for the joint venture, led by Woodside as operator, to negotiate with the two governments, so Government of Australia and Government of East Timor, a production sharing contract. So we've been having those conversations for the past few years. I'm cautiously optimistic that the recent attention on Sunrise may be the catalyst for the two governments to come together and work with the joint venture to finally land that PSC. And once that's sorted, then we can figure out, well, where do we go in terms of developing the asset.
Well, Megan Neal, Chief Executive of Woodside, thanks for your time today.
Thank you very much.
After the break, the Australian's business editor-at-large Ticky Fullerton talks migration with British Trade Secretary Anne-Marie Trevelyan. Welcome back. British Trade Secretary Anne-Marie Trevelyan visited Australia this week, meeting with British and Australian businesses in the green transport, technology and defence sectors. What has become clear is that Britain is well ahead of Australia in the race to attract skilled migrants to its shores. The Australian's business editor-at-large Ticky Fullerton caught up with the Trade Secretary to understand what we can learn from Britain's migration policies.
Trade Secretary Anne-Marie Trevelyan, welcome to Australia.
Thank you very much indeed. It's a pleasure to be here.
I've got to ask you, we are days away from finding out who the new British Prime Minister is. You're the other side of the world. Is it therefore business as usual, and will you be Trade Secretary in October?
So we leave it to whichever one of our two excellent candidates wins to determine what their new cabinet looks like. Yes. And I wouldn't dream of presuming what they might choose to do. But in the meantime, it is absolutely, as you say, business as usual. Trade, building our trading relationships, working particularly on my trip here in Australia and with New Zealand friends following the free trade agreements that I signed at the end of the year is critically important to the UK's economy and indeed to that really strong relationship we want to grow. So I'm here meeting with businesses, British and Australian, to hear more about how we can do that.
Well, you've hardly left the airport. You're starting with Qantas.
Well, that seems like a good place to start. Chance to catch up with them and hear about Project Sunrise, which is a wonderful collaboration between Qantas, Airbus and Rolls-Royce. Really exciting project, slightly terrifying when you stop and think about it for someone ordinary like me, but amazing, and to hear about how they're working together, both on the technical issues of doing that, but also looking at those important clean energy issues that sit around aviation, and Rolls-Royce in the UK and Airbus have been leading the way on sustainable aviation fuels, and it's been really interesting to talk to Qantas about how they want to be part of that revolution as well, leading in Australia.
So the tech side also leads you to electric vehicles. Mm-hmm. You're going to visit Jaguar Land Rover here as well. Britain's a lot further ahead, isn't it, with its transition to electric vehicles in terms of presumably infrastructure rollout. When can you no longer buy a petrol car?
So you're absolutely right. The UK has been world leading in taking on the climate change challenge and moving to clean energy, clean vehicles, and all those challenges we face to make sure that we decarbonise our economy across the board. For the UK, we have set a deadline. We put into legislation a number of years ago now that you will only be able to buy a net zero emissions vehicle in a car or a van, actually, not lorries. That's another level. It's slightly later, but by 2030. So that's in legislation. And what, of course, has been so interesting, when we did it, it seemed almost like an impossible challenge. I think we gave industry 11 years to do it. But actually, industry has, of course, taken up the challenge, and we are seeing incredible pace now. Government is supporting things like...
But it's because you've got that certainty.
Yes, exactly. And, you know, business will go, and, you know, of course, the consumer initially seemed like an enormously difficult manage. But, you know, apparently, I buy a new car about every 10 years, but apparently the cycle of cars is between 3 and 5 years. So between 2010, 2020 and 2030, in that movement, people are renewing their vehicles, and so it will be relatively easy and indeed eventually compulsory. That's what you'll find when you go to buy a new car, to do that. So that's what we'll buy. And of course, the challenge we have is we give an industry basically 10 years to build up the supply chain to make that possible and indeed viable financially. So we have given some support on the way through, but we are now seeing the numbers of people buying electric vehicles moving at pace as that quantity comes through the system.
Trade Secretary, we've seen the challenge to energy transition in the last 12 months. I mean, I'm looking at the regulators' new costs of energy for British households. They're £3,549, and they're going to go up again. It's 3 times what they were last year. There'll be fuel poverty. You were the, I think you were the champion leading up to COP26 in terms of negotiating on international change and adaptation resilience. How do you see what's happened now and how resilient Britain is?
So the huge challenges, and of course they're not limited to the UK, the disruptions to the supply chains of gas and oil, partly caused by COVID and of course the disruptions there, but the war in Ukraine and Russia's invasion of Ukraine has disrupted particularly the gas markets enormously, and as we have made conscious decisions to move away from use of Russian gas as well, the market spikes have been incredibly difficult. It's a commodity, so we are all affected by that gas price hike. Incredibly difficult. In the UK, we have already made enormous support, £37 billion for support for our consumers, which is just starting to come through.
Are there lessons for Australia? 60% of our energy on the East Coast still comes from coal. Should we be moving as fast as we are moving?
So the challenge for any country, and as the COP presidency, when we led the big question to the world last year, and Alok Sharma led that as COP president, was to challenge everybody to think about what their energy mix looks like now and how they set that route to net zero by 2050. Australia was able to come in just in time with a commitment, which was fantastic, and that's the starting point. So the UK is further ahead, without a doubt, both in thinking and indeed in helping our production of energy to become cleaner. 28% of all offshore wind installed across the world is around the UK at the moment.
Trade Secretary, we have a National Jobs and Skills Summit, and one of the questions will be what we do about immigration, skilled immigration, which business is crying out for. In Britain, the number of visas has gone up to 1.1 million. Now that's 70% above pre-Brexit levels. 492,000 study visas, 336,000 working visas. Did you have any pushback from unions or anyone else about opening the doors to skilled visas?
So one of the opportunities that came from Brexit was for us to be able to control our immigration policy once again. And in fact, we have in part copied the Australia with a point-based system in terms of how we are now able, because we are now free to manage our immigration. One of the things we've brought in is a global talent visa as part of the Department of International Trade's remit, where we are keen and welcoming to those who bring specific skills to help us, because the most important thing is to help our economy to grow. We are, of course, working very closely with our schools and colleges to build up where we know for those skills of the future, particularly in areas of clean energy, but in tech and in so many other of those next generational industries, how we can grow the skills from our own young people too. But in the meantime, we want to make sure that our businesses can grow and be as successful as they can be. So we're very keen and welcome those with those skills into the UK through that global talent visa.
And that includes, I think, 8,000 Australians who got a visa as well. But did you see any resistance, any political resistance to skilled immigration at all?
No, the UK has always been a very welcoming country. And I think when people voted for Brexit a few years ago now, the challenge around immigration was that it was not within our gift as a country to determine who we wanted to bring in and how we could manage that. And that is now what we have in place, and businesses and citizens are pleased with it. The important thing, I think, looking forward into the longer term is making sure that our own citizens have all the skills they need. So one of the things I did last year when I was Energy Minister working on COP26 and our domestic energy challenge was a Green Jobs Task Force, where we brought together over a number of months different sectors of our industries, our traditional industries and indeed those looking forwards, working together with government to work out what they needed us to do to set that long-term drumbeat of skills development.
But there was no link between the training that you're talking about now and bringing in skilled immigrants, because that's one proposal at the summit, that they should be linked because of concern about Australians losing jobs.
So I think in the long term, I mean, we have incredibly low unemployment in the UK. And what we need is more of those skills. So there are, I don't have the figures to hand, but there are literally hundreds of thousands of jobs vacancies in a number of high tech and next generation. And we want to make sure that we are providing business with the people that they need. We want them to be homegrown. I want to see my kids picking, jobs they want to do. But our economy is going gangbusters, which is fantastic. And what we want to make sure is that they've got the skills they need. So the Global Talent Visa is one that affords them the opportunity to bring people in who will add to our economic growth.
Trade Secretary Anne-Marie Trevelyan, thank you.
Thank you.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up with all the latest business news with our daily program Business Now at 4:30 p.m. and 10:30 p.m. Eastern Standard Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.